Hey there traders, I'm Lance Beggs from YourTradingCoach.com. For those of you not subscribed to my regular newsletter, I've recently produced an article explaining my use of tight stops, how I define them, and where I place them. I've had a request though for a video to give an example or two, so here we are today. Now, although there'll be a fair bit of repetition, I encourage anyone who hasn't read the article to do so first. So pause the video, go to www.yourtradingcoach.com, click on Articles down here on the left-hand menu, then click on Risk Management on the next page and search through the Risk Management articles for the one titled Tight Stops. So if you haven't read it, pause now, go to www.yourtradingcoach.com. Alright, we all know there's nothing more frustrating than being stopped out and then watching the trade move on to your target without you. So the usual response when that happens is that novice traders simply widen their stops to minimise the likelihood of being stopped out again in future. Which is fine as long as it includes a corresponding reduction in position size to ensure your risk is not increased. However, is that the right thing to do? What should we be using, tight stops or wide stops? Well, as frustrating as it's going to be for some of you, here's my take on it. There is actually no right or wrong answer with regards to stop placement, only what makes you money and what doesn't. So if wider stops provide a greater edge for your trading, then that's absolutely the right thing for you to do. What do I use? For me though, wider stops just don't fit with my trading style, my risk tolerance or my psychology. Tight stops are my preference. In fact, I'd even suggest that if you're tempted to widen your stops just to prevent yourself being stopped out, then perhaps the problem is more to do with your bad setups and entries than with your stop positioning. Anyway, let's discuss briefly what I mean by tight stops. It's my belief that regardless of whether a trader uses a tight stop or a wide stop, it should be in exactly the same place. Where is that? Well, the stop loss should be placed in a position which invalidates your setup. Now, in case I've confused you and you can't see how this can be in the same place, I'll try to draw it, so wish me luck. Let's consider a really basic setup. An uptrend with a retracement back to an area of support. Something like this. Uptrend. Price coming back to the previous swing high. To form now a swing low. And a possible area of support. We're looking for this support area to hold with us being triggered into a long trade in the direction of the trend up here. Stop loss positioning should not be, well, I operate with a 20 pip stop, so that places it down here. Or I operate with a 50 pip stop, so that puts it down here at this level. That's not correct. The stop should be in a position which invalidates your setup. And where is that? Well, for this setup, it's right here, just below the swing low. If price breaks the swing low after you've entered long, then there's a much higher probability that either something has changed in the markets or perhaps your analysis was wrong and this isn't a valid setup. Either way, you don't want to be in this market. Now, before I go on, I don't want to get caught up in whether the stop should be just 1 pip or point or cent below the swing low, or 2 or 5, whatever. Just define when you believe the setup is invalidated and be consistent. Okay, let's redraw. So we've got our uptrend. Price come back to our area of support, which has paused or possibly even turned a little higher. Our analysis says there is a higher probability of this level holding and of the uptrend resuming. So the stop goes here, right below the swing low, where the setup would be invalidated. So whether this is a wide stop or a tight stop is not a function of the stop positioning, because they're in the same position. It's a function of the entry point. If you require very little confirmation, and enter maybe right here, then you've got a very tight stop. If you require more confirmation, and maybe enter a bit later, perhaps on the break of the previous swing high, then you've got a wider stop, from the entry down to your stop loss. Obviously what each of us considers tight or wide is subjective. However, this is the general concept. The stop goes in the same place where the setup's invalidated, and the entry determines the amount of risk assumed on the trade, whether it's tight or narrow if you prefer, or whether it's wide. For me, I like the tight stop, so I'm looking to enter as close as possible to that area of support and to the stop area down here to minimize my individual position risk and maximize the room available to the next target level up here. Let's draw that again. In fact, in many ways, this is opposite to most traders. They'll find an entry and then work out the stop loss position. I'm different in that I'll often know where the stop is before I've worked out the entry. So here's our example here. Now I'll see price approaching this support area. I'll see the price stall or possibly even turn. And I'll know that I have a valid setup here. And if my analysis is correct, then price should not get down to that level. There's my stop. Now I just have to find an entry trigger. Often my entry price will be right at the open after my trigger candle. So say that's up here. That might be the entry point if I'm comfortable with that level of risk. Other times, if there's perhaps significant candle overlap occurring, I'll place a limit order a little further down, aiming for an entry at a better price before it continues in the long direction. If I can get a good entry, I'll take it, but if I can't get an entry that allows sufficiently small risk in accordance with my risk tolerance, then I'll just pass on that trade. So let's have a look at some charts, some recent price action, to demonstrate hypothetically how this concept might work. Okay, we have the British pound US dollar here. We're trading the 5-minute chart, which has a clearly defined uptrend, and using the 1-minute chart, which you'll see here, to refine the entries and just try to get the tight stops with entry just above support levels. Okay, we have price coming up here. A bit of a pause at the 48.50 level, which then manages to break out, go to higher prices, and retrace right back down to that 48.50 level. Okay, a little lower shadow, rejecting lower prices perhaps. The next one actually rejects higher prices, so not looking good, looking a little bearish. However, on the very next candle, price could not continue to act in that bearish manner and had a green candle. So at this point, I can quite comfortably say that the support level is holding and place my stop down here below the swing low. Entry anywhere within this area of congestion of these candles. Great opportunity on this next green one for an entry in the long direction. Okay, possibly stopped out here, but with an opportunity once again for re-entry, stop loss below the swing low, and entry within the congestion here for continuation in the long direction. Let's continue. Very similar price action here occurring again with congestion here, a bit of sideways action, possibly even small triangle, with a breakout to the upside and a retracement right back to the point of breakout, which is as price breaks above this doji here, comes right to that level on this candle here. Very similar to the price action before. The very next candle has an upper shadow, rejecting higher prices, looking bearish. However, the next two candles show that the price will not continue in that bearish direction, and support level is actually holding. At that point, I'm quite comfortable in placing a stop loss down here. There's my stop. I'm now looking for a tight entry, and my entry point will be anywhere within the area of this price action congestion here. Once again, for a trade in the long direction. And continuing once again, same price action occurring once again with sideways movement here, breakout to higher prices, coming back to our point of breakout for a nice doji candle, price trading above the doji. At that point, once again, support has held. I'm happy to place a stop down here below the swing low and look for an entry. And with little retracement back down to that area of support, great opportunity to enter close to support for a tight stop and trade in the long direction here. Value to make new highs, change to a downtrend, and we continue downtrend. Great opportunity here. Price comes down, excellent bearish candle here, rejecting higher prices, break into new lows, bit of a rally retracing back up to that point of breakout here. It's not a great retracement, but then we have this green candle here with an upper shadow rejecting higher prices, followed by some stall with some great red bearish candles. At this point, this area has held. I can happily place a stop here and looking for an entry within the congestion here for an excellent move to take us down into the close of that session. So that's basically what I'm looking for in price action with regards to tight stops. Okay, if you liked what you heard in this video, this is the kind of stuff I send out regularly through my newsletter, in articles and other videos at zero cost. So come along and join the team here at www.yourtradingcoach.com through the subscription box right here. I'm Lance Beggs from www.yourtradingcoach.com, wishing you, as always, happy trading.